we need to talk about the starting point problem. If you're looking at the S&P 500 right now and feeling like you're about to buy the top of a bubble, you're not crazy. The S&P 500 is the most concentrated it's been in decades. It's no longer a diversified bet on the US economy. It's a massive bet on 7 tech companies. If you buy a standard index fund today, you're buying those giants at historic valuations. But staying in cash is a guaranteed way to lose to inflation. So what's the middle ground? My take is that you shouldn't buy the market, you should buy the factors. I call this the factor fortress, and it's designed specifically to outperform when the giants eventually stumble. Most people pick stocks because they want to beat the market, but stock picking is a coin flip. Instead, we use financial engineering. To beat the market, we have to own the specific attributes that actually drive returns. Academic data identifies 3 primary engines. 1. Quality. Profitable companies with low debt. This is the safety trade. 2. Value. Cheap companies that the market has ignored. This is the reversion to the mean trade. And 3. Momentum. The winners that keep winning. The trend trade. The magic of this portfolio is that value and momentum are negatively correlated most of the time. When tech and momentum crash, value usually soars. By holding both, you smooth out the ride. It's set it and forget it because the math does the rebalancing for you. We aren't buying the total market because it's diluted with junk. We're using 3 specific ETFs to build our fortress. Pillar 1, JQUA. This is our quality play, designated at 34%. This is our anchor. It filters out junk companies and only buys the most profitable ones. It gives us the S&P 500-like returns, but with a much higher floor. Pillar 2, AVUV. This is a small cap value play, designated at 33%. This is our secret weapon. While the Mag 7 are trading at 30 times or 40 times earnings, AVUV is buying companies at 8 or 10 times earnings. It's historically the highest returning asset class over long periods. Pillar number 3, SPMO, the momentum play, designated at 33%. This ensures that we don't miss out on the rallies. If the tech giants continue to keep soaring, SPMO will capture that growth, acting as a hedge for our value position. Now you may be asking, why is this the best bet for someone starting today? Because markets move in 10-year regimes. The 1990s belonged to large caps. The 2000s belonged to small cap value, while the S&P 500 actually lost money. The 2010s went back to large caps. We are now statistically overdue for a regime flip. If you invest in the S&P 500 today, you are betting that the largest companies in history can defy gravity for 20 straight years, something that has almost never happened. If you invest in the factor fortress, you're betting on a mean reversion. You are buying what is cheap and profitable rather than what is popular and expensive. There's a 15% bull case where AI makes the tech giants so profitable that they never stop growing. But as an investor, I can't just bet on stories. You also have to take into consideration the probabilities. The factor fortress is a set it and forget it strategy that mathematically maximizes your risk-adjusted returns. It gives you the peace of mind to stop worrying about the top and start building wealth. What do you think about this strategy? Let me know in the comments. Make sure you like and subscribe for future updates. We'll see you in the next one.